大家好，欢迎来到 YouTube 大佬透镜，我们用一张 PPT 讲透大佬的深度分析。今天是2026年1月16日，我们来快速的过一下大摩亚洲团队昨天的周会，直接看要点。全球地缘风险高位，风险清单显著拉长，中东、伊朗、也门、沙特、阿联酋紧张，东亚的中日贸易、钓鱼岛摩擦，台海演习频率上升，俄乌僵局持续，委内瑞拉局势等叠加，美国就业压力缓解，通胀仍偏高，美联储关注重心正从就业向通胀倾斜，因此美联储难以快速转向全面宽松，短期内6月、9月降息仍是主流共识。中国人民币汇率短期可至 6.85， 年底回落到7附近，因中国央行要维持 CFETS 篮子基本稳定。注意，这是中国央行的名义有效汇率指数， CFETS 就是央行的外汇交易中心。大佬透镜认为，投资者更需要关注实际有效汇率，那么首推国际清算银行 BIS 的数据。当然 CFETS 指数能短期观察中国央行的政策方向。打个比方吧，名义有效汇率是冰山的海面上的部分，实际有效汇率是海面以下的部分。近期 CPI PPI 改善主要来自食品、黄金、上游，非核心需求回暖。若社会矛盾因通缩恶化，可能触发更快更强的政策。投资立场整体保持灵活分散，注重韧性。中国权益仍有短期吸引力，但需关注监管节奏，情绪过热与真实内需修复进度，增配抗波动资产，偏好日本权益如国防、科技硬件、保险以及黄金。注意他们再次提到了黄金，这和前面提到的地缘风险高位以及风险清单显著拉长是相匹配的。好，要点我们就分享到这里，接下来是播客风格的解读版以及带中文字幕的英文原声完整版。这里是 YouTube 大佬透镜，我们致力于过滤垃圾信息，挖掘优质内容，欢迎订阅、转发、常来。
今天我们为你准备了一份来自摩根士丹利的深度解读，时间是2026年1月15日，新的一年刚开始，但全球经济和市场已经给我们抛出了不少难题。
是的，
咱们手里的这份材料就是要帮你梳理清楚这些复杂的信号，比如说大家都盯着的美联储，他们下一步到底要干嘛？为什么现在做个决定这么难？还有全球股市开年好像涨得不错，但这背后是不是有点虚火？最后也是最有意思的，关于中国的分析，我感觉投资者和经济学家的看法简直就是冰火两重天。
没错。
好了，咱们一起来拆解一下。
这次分析的框架确实很有意思，它就像是在一层一层的剥洋葱。最外层就是全球宏观经济的这个发动机，美国。美联储一个小动作就能引发全球资本市场的风暴。
全球都得看他脸色。
对，往里一层呢，咱们看看全球市场的具体表现，哪些地方是热点，哪些地方在降温。最核心的就是深入剖析中国这个极其复杂的市场，这里面既有巨大的机会，也面临着非常独特的挑战。
好的，
需要提醒一下，咱们今天聊的所有观点都源于你提供的这份材料，我们的任务就是把里面的逻辑和关键信息给你讲明白。
好，那我们就从这个全球发动机美国开始吧。材料里说，现在预测美联储的动向变得异常困难。我有点好奇，过去我们总听说美联储最看重就业数据，只要就业一放缓，市场就预期他们要降息了。但这次为什么好像不是这么回事呢？
你问到点子上了。这正是这次情况的特殊之处，也是摩根士丹利内部之前激烈争论的焦点。
他们内部也有争论。
是的，你看啊，最近几个月的非农就业数据，平均每月新增也就5万左右。
5万，那和以前比是少很多了。
对，大幅放缓。按照老剧本，失业率应该要上升，美联储就该准备降息救市了。但这次的剧本完全不一样。
哪里不一样了？
美国的失业率不但没上升，反而在低位徘徊。最近的数据甚至还被向下修正了，
这就奇怪了。
报告里给出了一个非常有意思的解释：人口动态的变化。
人口动态，
简单来说就是美国的移民数量急剧下降，从几年前的每年大概300万骤降到现在几乎为0。
哇，这个角度很新颖。也就是说，不是找工作的人变多了，而是整个劳动力的蓄水池本身变小了。
完全正确。
所以即使新增的岗位不多，失业率也一直这么低， 我以前还真没怎么想过。
就是这个道理，劳动力增长放缓，分母变小了，所以失业率这个指标就有点失真了。这就给了美联储一个非常重要的理由。既然就业市场没有告急，那他们就可以把全部注意力都集中在另一个更头疼的问题上——
通胀。
对，通胀。材料明确指出，通胀在未来几个月可能还会保持在高位。
所以结论就是，
别指望很快降息了。无论是市场还是摩根斯丹利自己，都已经把首次降息的预期时间点推迟到了今年的6月，甚至9月。
那对股市来说意味着什么？降息推迟，按理说是坏消息，但美股好像没怎么跌，似乎不太在乎这是噪音。
对，市场现在的反应确实很平静，但这背后材料指出了一个更深层次也更关键的问题。这个问题将决定未来市场的真正走向，那就是美国经济现在的增长到底是由什么驱动的？
这里面还有讲究，
有2种可能性，结果天差地别。
哪2种？
第一种是最好的情况，强劲增长，同时伴随着低通胀。如果真是这样，那就说明美国的生产率正在飙升。
比如说 AI 技术的应用终于开始显现效果了。
没错，有点那意思，这是非常健康的增长，对股市是极大的利好。
但还有第2种可能，那就是增长强劲，但通胀也居高不下。这说明什么？说明没有生产率的提升，纯粹是需求过热。
我来分析一下，第2种情况就像是经济在发烧，而不是在长个子。
这个比喻很形象。如果是发烧，那美联储可能不但不能降息，甚至还得考虑加息来给经济降温。
那对股市来说就是巨大的风险了。
毫无疑问。所以未来几个月的数据至关重要，尤其是美国政府停摆结束后会发布一批积压的数据，到时候我们就能看得更清楚。经济到底是在长个子还是在发烧？这确实是个全球性的问题。美联储的决定就像一只蝴蝶在华盛顿扇动翅膀。
是的。
那除了影响利率，它的决定还会从哪些方面影响到其他国家呢？
影响是全方位的。美联储的利率政径直接决定了美元的强弱，从而影响全球资本的流向。
比如说欧洲和亚洲这些经济体，他们自身的经济复苏本来就需要更宽松的货币环境，但如果美联储迟迟不降息，他们也不敢轻易行动，
怕利差拉大，资本外流。
对，可以说全世界的央行都在等美联储先出牌。
所以美联储这边的情况很微妙。那这种不确定性又是怎么反映在全球市场上的呢？开年以来，市场表现好像还不错。
是的，2026年全球市场来了个开门红，几乎所有市场和板块都在上涨，气氛相当不错。报告里还提到了一个有意思的统计数据，算是一种玄学吧。
哈哈，还有玄学。
从历史上看，如果新兴市场在年初的前5个交易日是上涨的，那么这一整年取得正回报的概率超过60%。
哎呦，
日本市场甚至更高，能达到2/3。
听起来像是个好兆头啊。但这只是个普遍现象，具体到不同的市场，表现应该还是有差别的吧？
差别非常大，尽管是普涨，但分化很明显。领跑的是韩国和中国台湾。报告认为，这主要得益于他们在半导体和国防工业这2个热门领域的强势地位，
又是 AI 芯片的需求，
对，让他们赚得盆满钵钵。而表现落后的则包括澳大利亚、东盟的一些国家。
我注意到报告里还特别提到了印度，似乎表现也不尽如人意，这有点意外。印度不是前2年的明星市场吗？
没错，这正是报告中一个值得玩味的地方。印度的疲软表现与摩根斯丹利自己对印度市场适度超配的观点形成了挑战。
看来即便是顶级策略师，市场也总会给他们出难题。
是的，行业方面分化也很清晰。半导体和存储芯片因为 AI 的需求依然是当红炸鸡，而最不被看好的是能源板块。
能源
分析师们已经把2026年布伦特原油的平均价格预期下调到了每桶57.5美元。他们认为全球供应非常充足，油价很难再有大的作为。听下来，市场虽然开局不错，但内部冷热不均。不过我感觉这份材料里反复在强调一个更大的担忧，就是市场的平静和现实世界的混乱形成了鲜明的对比。
你抓住了这份报告的风险提示核心。你看，衡量市场恐慌情绪的 VIX 指数，还有外汇市场的波动率，都处在非常低的水平，市场一片祥和。
对。
但你再看看新闻头条， 美伪关系紧张、中日摩擦、中东局势，地缘政治的火药桶一个接一个，这种巨大的反差本身就是最大的风险。
所以报告给出的建议也很直接，2026年别指望能一帆风顺。
是的，
你的投资组合得够抗打，得能扛得住市场随时可能出现的大幅波动。
正是如此。报告里用的词是为不确定的世界采取稳健的策略，意思就是灵活性和防御性在今年会变得异常重要。
聊完了全球的宏观和市场表现，我们终于来到了最核心的部分。说到复杂和不确定，恐怕没有哪个市场比中国更典型了。这份材料里描绘的景象可以说是冰火两重天。
的确如此。我们先看火的一面，也就是从投资者和资金流的角度来看，这一面市场情绪非常火热。
火热。
报告指出 ，A 股市场正在迎来一股强大的流动性，可以说是水牛行情。这股水主要来自3个源头。
哪3个源头？
第一是债市搬家。之前利率低，很多资金都趴在债市里，现在看到股市有机会，就开始往股市转移。第二是存款搬家。很多散户投资者看银行定期存款利息越来越低，也开始把钱取出来投进股市。
这个我身边就有。
第3股力量来自保险公司，在监管的引导下，他们也在逐步增加对股票的配置比例。这3股水汇集在一起，推动了市场的上涨。
明白了，就是钱太多了，总要找个去处。那这些钱都流向了哪些领域呢？
报告里也给出了明确的方向，重点关注的是那些代表未来的板块，比如 automation、robotics、biotechnology 和高端制造业。
新兴产业。
对。同时建议避开那些传统的消费品和房地产相关的行业。另外，不光是 A 股，香港市场的表现也很抢眼。年初到现在，已经有11家公司 IPO， 首日平均涨幅超过30%。
哇，
这在全球来看都是非常吸引人的，吸引了很多国际机构投资者的目光。再加上人民币对美元升值，突破了7.0这个重要的心理关口，也让人民币资产显得更有吸引力。
听起来确实很火热，但我注意到报告里也提到了监管的动作。A 股的交易量和融资余额都创了历史新高，然后监管就出手了。
对，收紧了融资保证金的要求。
这个融资余额创了新高，意思就是说借钱炒股的人和资金量都达到了一个顶峰，对吧？这听起来就有点危险了。
你的理解完全正确，融资余额达到3800亿美元的顶峰，意味着市场的杠杆已经加到了一个很高的水平，投机情绪非常浓厚。报告里提到，摩根士丹利自己编制的 A 股情绪指数，当时已经飙升到了93，100是满分。
93？那不是乐观了，这是狂热啊！
没错。我们的交易员当时开玩笑说，市场情绪热的都快烫手了。所以监管在这个时候出手降温，报告认为是一次非常主动和健康的举措，目的就是挤掉一些泡沫，而不是要打压整个市场。
好的，这是火的一面，流动性驱动的狂热。那冰的一面又是什么呢？
冰的一面来自宏观经济学家的视角，他们看到的现实要冷静得多，甚至可以说是有些寒意。他们认为2026年第一季度接近5%的 GDP 增长，主要是靠基建投资拉动的，这种增长模式可能很难持续。核心问题是国卫需求还是偏弱，通缩的压力也一直都在。
这里提到了负财富效应，这个概念能帮我们通俗地解释一下吗？
当然，所谓负财富效应其实很简单。你想，对于大多数中国家庭来说，最重要的资产就是房地产。
对，
当房地产市场下滑，房价下跌的时候，即便你没有卖掉房子，你也会在心理上感觉自己的财富缩水了，感觉自己变穷了。
有这种感觉。
再加上工资增长本身就比较乏力，这种感觉会更加强烈。当人们觉得自己变穷了，自然就不敢花钱，会捂紧口袋。这就是抑制消费的负财富效应。
我明白了。所以一方面是股市里热钱翻滚，另一方面是普通老百姓因为感觉自己变穷了而不敢消费，这个反差太大了。
是的，这种需求疲软也直接体现在通胀数据上。 经济学家特别指出，虽然最近的 CPI 和 PPI 数据看上去有所回升，但如果你仔细分析结构，就会发现上涨的主要是黄金、食品这些上游大宗商品。而真正反映终端消费需求的核心 CPI 和下游 PPI 依然非常疲软。
所以报告给出了一个很精准的判断，今年是通缩减弱之年，而不是再通胀之年。
没错，也就是说，最坏的情况可能过去了，但远没到可以乐观的时候。
基于这种宏观判断，他们对人民币的走势看法也不同了，对吧？
对，投资者看到的是资金流入和人民币升值，但经济学家看得更长远。他们认为，虽然第一季度人民币可能因为市场情绪好而升到 6.85， 但到年底可能会重新回落到 7.0。
原因呢？
原因有两个，一是他们预计下半年美元会重新走强，但更根本的原因是持续的通缩会拖累中国资产的整体回报率。对于全球投资者来说，如果在一个国家投资的回报率持续低迷，资本自然就会流出，这会对汇率造成长期的压力。
所以这就是理解当下中国市场的关键。你看到的是一幅双重景象，一方面是投资者在流动性的盛宴中狂欢，另一方面是经济学家在为实体经济的疲软和通缩的阴影而担忧。
对，
如何在这冰与火之间做出判断，是所有投资者今年面临的核心课题。
总结得非常到位，这就是这份报告揭示出的关于中国市场的核心矛盾。
好了，今天的信息量确实很大，我们来快速回顾一下这次深度解读的核心要点。第一，在美国，别再只盯着就业数据了。未来市场的关键在于判断美国经济的增长到底是来自健康的生产率提升，还是仅仅是需求过热导致的发烧，这将决定美联储的最终决策。
对。
第二，在全球市场，虽然开局强劲，但市场的平静和地缘政治的混乱形成了巨大反差。2026年注定是充满波动的一年，稳健和灵活是投资组合的关键字。
没错。
第三，也是最复杂的，中国市场呈现出冰火两重天的景象，投资者正因充裕的流动性而兴奋，但经济学家对持续的内需疲软和通缩压力始终保持着高度警惕。
在我们结束之前，这份材料最后还提到了一个可能性，我们想把它作为一个问题留给你思考。
好的。
报告中说，北京方面可能会在3月份的全国人民代表大会之后，考虑出台一些更直接的刺激消费的政策，比如给购房者提供抵押贷款利息补贴，或者直接发放服务消费券。
这听起来确实是更强力的措施。
是的。那么我们留给你思考的问题就是，如果这些政策真的出台，你认为它是否足以从根本上扭转国内需求的疲软态势，因此最终战胜通缩的拖累？或者说，它会仅仅是又一个短期的兴奋剂，给火热的股市再添一把柴，但对冰冷的宏观现实却收效示威？这个问题的答案将深刻地影响未来中国资产的走向。
My name is Crystal G, Asian EM Market Strategist. Before we start, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of press. If you are a member of the press, please log off and reach out separately. Please also note that this webcast and your questions may be recorded. Today, we have Rajiv Sibal, Senior Global Economist, Jonathan Garner, Chief Asian Emerging Markets Equity Strategist, Laura Wang, Chief China Equity Strategist, and Jenny Zheng, China Economist. During this session, you can send the questions at any time from the Ask a Question text box. First up, we have Rajiv today online to share the new Fed outlook and also how data is tracking on the ground. Over to you, Rajiv.
Hey, good afternoon, everyone, and good morning for those of you in the Middle East with me. I wanted to kind of give you a little bit of an update on what we're seeing in the economy globally, but also I'm going to start really with the U.S. because we view that the U.S. is driving the outlook for the next couple of quarters in terms of risk sentiment. The Federal Reserve has been in a difficult position. Markets have been volatile in terms of pricing Fed expectations. And Morgan Stanley, unfortunately, similarly, has been in a similar boat in that we found it difficult to forecast the Fed over the past couple months. And I'll explain to you why that's been happening. Our call now is very much in line with market pricing for June and September. But those of you that are close followers of Morgan Stanley economics research will see that we had some debates of whether or not the Fed would be cutting in December and January. And the timing around that is really linked to the data dependency. We've for some months now been highlighting that the first 2 quarters and the last meeting of 2025 and the first 2 quarters of 2026 are going to be very difficult to forecast because the Fed's reaction function is shifting between employment and inflation. And so in Jackson Hole last year, when the Fed kind of pre-announced that they were going to start cutting, it was indication to the market that the Fed was very much focused on employment. And in line with Morgan Stanley forecasts, non-farm payrolls started to trend much, much lower. In fact, I can show you the non-farm payroll prints of recent months have been trending much, much lower towards an average of near 50,000. And you can see that in this image here on the left with the blue bars, and the 3-month moving average is the yellow. And in our forecast for 2025 at the beginning of the year had very much been for a deceleration of non-farm payrolls towards the 0 level. The problem with just the payrolls is that the unemployment rate in the United States has been fluctuating quite a bit. And unemployment started to move a little bit higher when we initially got some of those weak data points in non-farm payrolls in Q3 last year. What we saw, and that's when the unemployment rate went higher, we saw that the Fed was cutting interest rates. What we saw in the non-farm payrolls last week, however, was that the unemployment rate got revised lower. And a lot of this has to do with population dynamics in the United States. Just like a few years ago when we were having upside surprises to the labor market as U.S. population was increasing, in 2025 and 2026, we're similarly experiencing downside surprises to the U.S. labor market because the U.S. population growth rate is shrinking to almost 0. 2 years ago, the United States was having in the region of 3 million new immigrants a year, and now that has fallen to 0. And the implication of that is that you get slower job growth, which you're seeing in the non-farm payrolls, but it also means that unemployment doesn't necessarily move as much as you would expect when non-farm payrolls is this week. And so what we saw in the non-farm payroll data in January for the December outcomes was that unemployment fell back really, really low, and previous months were revised lower. And so the implication with unemployment being below 4.5 and down to kind of that 4.3 level is that the Fed probably needs to start shifting their focus away from employment towards inflation. And you can see that the inflation, which is the chart on the right, is going to remain elevated for a few more months. And so as a result, both the market and Morgan Stanley, and I'll shift back to my original chart, have pushed interest rate cuts from the Fed out to June and September. And the rationale for that is basically that if the unemployment rate is really low, then the Fed is going to be focused on inflation. And this could change over the next few months again. It's going to be very dependent on the data that we get. If you get some downside surprise in inflation, you could see those cuts pull forward. If you get upside surprise in the unemployment rate, you could see those cuts pull forward. The data dependency is going to be the name of the game in 2025. Now, equities seemingly have decided that this does not matter as much. And that may be the right answer for a general risk perspective, because you're really talking about 2 cuts, and this is a matter of when. The Fed median dot plot has 1 cut, so even if you get 2, you're getting more than the Fed is currently projecting. And so in that kind of environment, equities seemingly have started to ignore a little bit of the noise. But for fixed income and FX, this does continue to matter. Where the question will lie is how strong is U.S. growth over the next couple of quarters, because the construct of U.S. growth will determine what the Fed path looks like. And so if you see on the right-hand side on this chart, growth was very strong in Q2 and Q3 last year, but a lot of that strength came from inventories and notably net exports. That net exports is not a stable growth indicator. It's just showing volatility around tariffs. As that yellow bar tracks down, we should expect growth to decelerate, not to a low level, but just to a kind of a trend consumption level, which is where these green bars are sitting at. And that's just around that 2% level of growth. And that's what we're forecasting for the next few quarters. Now, that's the baseline. And in that kind of world, we would be in line with market pricing that the cuts come in June and September. The questions come, and this is where it becomes really interesting, is if we have strong growth but low inflation, is that an indicator of productivity? Because if productivity is increasing in the United States, as you can see on the left-hand side, the Fed would be in a better position to cut interest rates earlier. If, however, growth remains really strong and we don't get the productivity boost, there's a risk that the Fed may actually have to hike rates, or the Fed won't be able to cut rates as expected, which is this blue bar. And the answer to that question, I think, is very important for equities. And I think we will better understand the answer to that question after we finish getting the data after the government shutdown and see what Q1 looks like. And so I think, right now, the baseline for the Fed is shifted to June and September, but that baseline very well may change over the next few months, depending on this path of which direction we're headed. Now, equities are very much, I think, looking forward to the yellow line, and the risk to equities might be that we're a little bit more on the blue line, or that growth is not as strong as expected. But for now, the answer economically to this question probably will take a couple more months to answer. And I think this is important not only for US, but also for global risk. A lot of our call globally was that as the Fed could start cutting rates, it could help lower real interest rates in other economies, particularly in Asia, in emerging markets, and in Europe. And a lower real rate in those economies allowed for a domestic demand cycle to take place. And so the path of the Fed will really have a translation effect in terms of when other central banks can cut interest rates and what the U.S. demand may mean for the export-oriented economies that exist in the world. So maybe I'll stop there. I've been speaking for a little bit over 5 minutes, and hand it over to Jonathan, who maybe can take what this means in a risk context.
Sure. So thank you very much, Rajiv, and Happy New Year to everybody. I'll just also share a screen here on a note that we put out right at the start of the week, which is on performance early in 2026. So we do this every year as an exercise. And the good news, we'll start with the good news, is that markets are up. Almost all markets and almost all sectors are up. And when you look at this on a sort of a statistical basis, albeit, of course, we only have maybe 35, 40 years of history, markets where we're up in the first 5 trading days, and here we're looking at EM, it's about like 60% plus of the observations that the year as a whole is a positive one for returns. Whereas you see on the right-hand side, there are obviously fewer years where we start off down, but it slightly edges it to being a bad year if you start off down. So we've started off up. And in fact, if you look at Japan, and this is topics, it's even stronger. Because obviously over the famous 20 years where Japan was not performing well, we often started down. These distributions are more matched. But actually starting up for Japan is about a 2/3 hit rate for the year as a whole, being positive. So that's good. And if you look at the performance, it's led again by Korea, skewed to semiconductors, defense, industrials, and Korea value up. Smaller markets are also working, like Colombia, Peru, Turkey, Greece, but then another very large one, Taiwan. And then the underperformers are in Australia, parts of ASEAN, and India notably is failing to rally. So we do mention in this piece that we put out that that's not our view. We think the cyclical recovery in India is already underway. And we do have a moderate overweight on India, but that's clearly challenged with early market pricing. Our constructive views on Japan in particular are coming to fruition. Now, here, if we look at the sector performance, it's very striking just how well semiconductors and memory names are going. And so that's in line with our bottom-up analyst view. We went into this year broadly neutral on this sector. AI demand is clearly still very present. There's a lot of excitement about the IT sector in relation to China AI as well. Notice on the far right here that upstream energy is underperforming, despite some of the geopolitical risk events that are happening. We've actually had a cut in our Brent oil price forecast from Martin Ratz, our analyst in London, and the team. We're expecting a weak market for Brent, $57.50 a barrel average for 26. The market is very well supplied. There's a transition, obviously, to other forms of automotive technology that aren't so oil intensive. And that is a key underweight for us. So it is our largest underweight, energy. Materials, very diverse performance. Obviously, gold and precious metals doing well. Some other materials likewise. And in Japan, a few little points to notice here. Banks have started well. Some parts of machinery, particularly things that are geared to the industrial defense cycle. I notice retail trade doing quite badly, and that is related to China-Japan trade tensions, which are underway. So inbound tourism stocks and some consumer stocks in Japan generally are not performing well. Now, within all of this good news, I do want to highlight that geopolitical risks are very elevated. So over the holiday period, we had action by the US on Venezuela. We have those tensions between China and Japan. We had issues between UAE and Saudi Arabia over Yemen. We've got an ongoing situation in Iran that has the potential to change the narrative for the Middle East. It is noteworthy that if you look at FX volatility, it's actually been declining, including for the Taiwan dollar. We just have on this chart that hopefully you can see here a few spikes in Taiwan dollar 1 month option implied volatility around Nancy Pelosi, the former speaker's visit to Taiwan, the Taiwan presidential election in early 24, and obviously Liberation Day last year. But the market at the moment is pricing currency volatility lower, including for Taiwan. And we just leave that question hanging somewhat. In a follow-up pulse note yesterday, we mentioned how low VIX is in the US, and rate volatility is also low. Over the course of yesterday, actually, VIX rose significantly. So we are starting to see it just really in the last 24, 48 hours, more of a response from macro markets to this constellation of geopolitical risks. But there's also plenty of idiosyncratic risks going on inside the United States itself over the Federal Reserve, over monetary policy, and indeed micro initiatives from the administration affecting some quite large sectors in the US market itself. So it is, in summary, a good start for the year. We shouldn't sort of negate that. That's the good news. But be careful. And overall, we're continuing to expect, as we say in the title here, a volatile year in 26. So our overall theme for the year is a robust approach for an uncertain world, making sure that your portfolio is going to be able to survive some quite significant swings through the course of the year. And that's it from me. I'll stop the share there. And thank you, Crystal. Back to you.
Thanks very much, Rajiv and Jonathan. Now we are shifting to China before we take any questions for the two speakers. China has performed very well this year, and then today we have Laura as a speaker to share her outlook for 2026.
Thank you very much, Crystal, and thank you for this opportunity to talk to all of our investors online. Yes, we remain cautiously optimistic towards Chinese equities coming into 2026. We actually see quite positive and strong liquidity support for both the onshore Asia market and for the offshore Hong Kong market, and we'll talk about those two markets separately. For the onshore Asia market, actually we've been highlighting since late last year that there is a very clear trend of bond allocation moving gradually into equity allocation. And also we are noticing that for retail investors or for the general households in China who used to actually deposit cash for lack of better investment opportunities and who were attracted by relatively higher interest rate about 3-4 years ago. And these investors actually are also gradually moving their term deposit cash into the equity market allocation as we speak. If we think about the onshore treasury bond yield, the 10-year bond yield and the 30-year bond yields have both been picking up since November. I think partially that reflects somewhat improving outlook expected by the institutional investors onshore. But I also take that as a sign that the onshore regulators and policymakers are actually waiting to see more bond allocations being allocated into the equity part of the universe. And then we should not ignore insurance buying. Insurance companies have been doing extremely well, and insurance as a sector is something that we recommend you to get exposure to in your China portfolio. The insurance companies have been doing extremely well, and their year-on-year premium sales actually have also been picking up very nicely. Insurance companies have also been guided by onshore regulators to gradually increase their equity allocation. So we actually see a combination of premium sales pickup as well as the gradual increase of equity allocation as a percentage of the insurance portfolio as a strong catalyst for money from insurance companies into the equity allocation. So with all these three combined, we think the liquidity support for Asia market will be very strong. And also thinking about the opportunity set, which is very much in the categories of automation, robotics, biotech, and high-end manufacturing. Those are the unique opportunities that would be exclusively available in the Asia market. We think the outlook continue to be quite strong. But we do advise against some conventional, traditional consumer sectors such as staples, and we do not recommend investors to actually put money into the property sectors because we still see very heavy deflationary pressure, and those pressures are particularly casting some doubts on some of these Asia sectors. And for the Hong Kong market, actually, we see a very strong start of the year in the IPO market with 11 IPOs so far, and these companies achieving on average more than 30% of first day stock price increase. So I think that's been attracting a lot of institutional investors from all over the world. And then secondly, CNY against US dollar has been appreciating gradually, and that has also particularly breaking level 7. So that has also served as a strong catalyst for foreign investors to look at Chinese assets. Our China economics team, I think later Jenny could potentially be talking about this as well, recently revised their CNY USD forecast, and they are at least expecting minor, more deep appreciation of CNY against US dollar for the first quarter of this year. So I think that fund flow support from foreign investors attracted by the high quality IPOs in the market, as well as the rising attractiveness of Chinese assets in general, would serve as a strong catalyst. I think just very quickly, a quick comment on the margin financing tightening that was announced yesterday by onshore regulators. So what had happened is that we are seeing record high trading volume in the Asia market, approaching 4 trillion RMB, the highest ever. And also the margin financing balance is also making new record high in the Asia trading history, around $380 billion US dollars. So what had happened is that the regulators announced for the margin financing collateral ratio, they are increasing that collateral ratio requirement from 80% to reduce that from 100% to 80%. And actually, as a result, the leverage that would be tapped into by margin financing investors would effectively be smaller versus before. We take this as a very proactive action by the regulators to try to tame some of that overheatedness in the Asia market. We published this Morgan Stanley proprietary A-share sentiment index on a weekly basis. And as early as January the 6th, actually, our Morgan Stanley A-share sentiment index had already indicated overheating sign. And the past Monday, this index, which remain range bound somewhere, the range should be 0 to 100%. The past Monday on January the 12th, our A-share sentiment index actually hit 93%, which is extremely high. So we were not really surprised by this, but the sort of the tightening or taming of the regulators of the A-share sentiment. But as I said earlier, we think the main liquidity contributor comes from the bond allocation back into equities, the term deposits, and insurance institutional money. So we actually think that this is a healthy move to actually contain the sentiment a little bit, but it should not be really fundamentally disruptive to the Asia market sentiment at the moment. With that, I'll hand it back to Crystal. Thank you.
Thank you very much, Laura. And then last but not least, we have Jenny online, and then the China econ team, they have upgraded their forecast for the currency. Can you talk about your views and also the sentiment tracker?
Hi, everyone. Happy New Year. So for China, we can see 2026 marks a very strong start with the infrastructure push, renminbi appreciation, and stock market rally. Then over the past week, the key investor questions we have got is whether such strength can be sustained and how long it can last. We think China's real GDP growth can be lifted from around 4.5% last quarter to close to 5% in the first quarter of this year on a stronger public capex. And we think the USD CNY can inch lower toward 6.85 on strong exports and weak dollar. But domestic demand weakness and persistent deflation will still keep the upside. Then if we zoom in on the growth, we see very strong signs of the public capex front loading. Both the advanced central budget for infrastructure and the local government debt issuance plan for the first quarter are 50% higher than the same period last year. And if we look at the high frequency data, we can also see like the Siemens shipment has shown a stronger than seasonal rebound and the margin. But on the other hand, we need to see that the consumption has remained subdued given the weak wage growth and the increased negative wealth effect from the continued housing downturn. And overall policy has remained quite supply-centric and reactive. And we only see the continuation of the cash for clunker program, but there's no stronger support for consumption, and also we cannot see the signs of additional support for the housing market in the next couple of months. And therefore, we believe that even if the first quarter real GDP growth can pick up to around 5%, this cannot be sustained. Then on inflation, some investors are taking the recent CPI and PPI improvement as a sign of a nascent reflation. But if we look at the data breakdown, you can see the recent uptick has been mainly driven by higher prices in like gold, food, and some upstream sectors. But sequential price growth in core CPI excluding gold and the downstream PPI has remained soft. And we think this actually is a better reflection of the final demand, and it's still very weak. And given the continued supply-demand imbalance and slow policy move to support the property market and service consumption, we think this year is just a year of less deflation rather than reflation. Then last on renminbi, yes, we recently upgrade our forecast path and see the USD CNY can reach 6.85 by end March. This is a mark-to-market adjustment to recognize the China's stronger than expected exports and dollar weakness. But we are more conservative than the market on the renminbi performance beyond Q1. And we think the USD CNY can fall back to 7 by year end. And that is based on two reasons. First is that we believe the dollar weakness is just temporary. The stronger than expected US economic growth and the slowing Fed rate cut pace may lead to dollar rebound in coming quarters. And they will put the downward pressures on the USD CNY. And also we think a more fundamental reason is that although we remain constructive on China's export this year, the export alone is insufficient to justify the sustained renminbi depreciation, because from the left-hand side chart, you can see here. On the left-hand side chart, you can see that China still has the capital outflows amid the deflation. The continued deflation would drag on China's asset returns and reduce their attractiveness to foreign investors. It improved a bit last year, but it still remains the case that the renminbi asset has a relatively low return as compared to assets in other countries. And Japan's experience in 1990s also tell PBOC that the currency appreciation should be the result rather than the driver for the economic rebalancing, because it will hurt the export growth, and that is one of the very few growth drivers left in the economy for now. And weaker exports will also lead to weaker wage growth slowdown and just worsen the deflationary pressures. And therefore, we believe the PBOC will allow modest renminbi appreciation against the dollar when dollar is weak. But in the meanwhile, it will keep the renminbi CFA basket largely stable. And to this end, we can see from the right-hand side chart that over the past months, the PBOC has been very rarely adopted the counter-cyclical factor for the CNY fixing to control the pace of appreciation. So what is the way out? We think the key will remain on more policy efforts to help to rebalance the economy. In our base case, we assume that Beijing will consider the mortgage interest subsidies post the March MPC, and they may also think about the service consumption vouchers in the second half of this year. But they will start with pilot programs. But if the social dynamic accelerate the deterioration due to the deterioration of the deflation, then it could push for faster and stronger policy actions to ensure the social stability. Yeah, let me stop here and then hand over to Crystal. Thank you.
Thank you very much, Johnny. And then now we will move on to the Q&A session. John, if you still have the time, just one question here for you. So do you see a rotation among markets and sectors for 2026? And then because so far year to date, what have outperformed is quite similar to last year.
Yeah, that's a fair comment, that the performance trends from last year are continuing. Well, to be clear, the performance trends for the year as a whole, there was actually a very meaningful correction, for example, in defense stocks in the fourth quarter. So we had a lot of questions about that, about whether that outperformance would resume. And obviously around Liberation Day, there was a huge reversal in semiconductor stocks. So yes, broadly speaking, things are continuing on the same path as last year. Energy was the key sector underperformer last year. In terms of our own views, we're recommending quite tight market risk positions, a slight preference for Japan over EM. Japan's performance has actually accelerated in terms of outperformance in EM in the last few days as Takeshi Sane is moving towards calling a snap election, and the market typically trades well in the run-up to snap elections. So that's certainly worth watching. We'll try to keep you posted. We're making some quite strong stock calls in our various focus lists, including the newly launched thematic list. It's going to be a year when one has to be nimble to maintain this overall robust approach. Thank you.
Thanks, Jonathan. And then there are several questions for Rajiv on the line as well. I will just ask them one by one, perhaps. The first one is that you have been mentioning that delay in tariff impacts has been quite significant given the freight time also inventory. So how much of the current inflation, which is still elevated, is caused by that? And then how much is the underlying strength of the consumer?
Hey, Crystal. No, so that's a great question, and it's key to what's going to happen. Also, because we should be getting a Supreme Court ruling on IEEPA tariffs very soon. Our general, the way I like to think about it, I mean, we've been tracking it, and if you go into, there's a fellow named Diego Anzotegui, and if you go into the Morgan Stanley website, he's our inflation modeler, and he works with our chief U.S. economist, Michael Gapin, and you can get into all sorts of detail on our published research. But at a high level, the way I think about it is U.S. core inflation is probably running closer to 2.5. And as you saw in the last print, we were around 2.7. We think that goes, the PCE implication of that is 2.8. And it could go up to 2.9 over the next few months. So I would suspect that 20 to 30 basis points of the push that we've seen over the past few months is really led by tariffs. And so the Supreme Court, and our general expectation is that starts to fade by the end of Q2. And so that's why we have the Fed cutting in June, is that by that point, you'll have seen the top of the inflation from the tariffs, and you start to move towards 2.5 inflation level rather than the kind of just below 3 where we're sitting at. Now, if IEEPA is ruled illegal, the shape of that ruling could affect the timing of that. And so I think that'll be a very important thing to watch early next week. But that's the way we're thinking about it.
Thanks, Rajiv. And then the second one is, so if you get the new Fed chair, what's the implications on the rate path from here?
So this is the other reason I think the court rulings really, really matter. You know, the subpoena of Jay Powell last week was pretty historically unprecedented. And Senator Tom Tillis, who's senior member of the Banking Committee, has suggested that they won't push any Fed nominees until this subpoena is resolved. So I don't know if that's true, but the point being, this is a reflection of the tension that exists in the U.S. and in Washington, D.C. about whether or not they nominate a Fed chair who is deemed to be independent. Now, clearly, if a Fed chair that is a little bit less independent is placed, then there are risks to rates. But as we've written in the past, there are a lot of institutional safeguards at the Federal Reserve that make that a low probability case in the next 1 or 2 quarters. Obviously, the risks increase if there's more power given to, by the Supreme Court to the administration to change different governors. But for now, the institutional safeguards are in place. And so our baseline scenario is that we do not get somebody that is just going to do things politically. And this is why, from a technical economic standpoint, what I was discussing before about productivity or not is very, very important. Because if we are in the midst of a productivity boom, there's a very sound, rational economic explanation to cut rates. So that's why, independent of who the Fed chair is, the data over the next couple of quarters is going to be really important, because if we're in an aggregate demand-led world, that creates one path for interest rates. If we're in a productivity-led world, then that creates a different path for interest rates. And that's really what we were trying to present in those 2 scenarios that I used in my image when I started this presentation.
Thanks, Rajiv. And then we still have 2 questions for you, and then I would just probably ask them together. Trump seems to be very focused on the housing affordability, and then how does it impact growth and inflation? And then the last question for you is how is consumption trending in US, and then have consumers felt the hurt from the elevated inflation?
So I'll do the latter one first. So inflation, consumption is tracking just around 2% in the U.S. This is a deceleration from Q3, but it's still strong consumption. The problem is that we're getting a lot of noisy data during the government shutdown, and like retail sales, which was surprised to the upside yesterday, is printed in nominal terms. And so we really need to see kind of what the PCE is in order to understand the real component. But generally speaking, we're tracking around 2% consumption right now, which is a healthy level. And the consumer is feeling, you can see in the disaggregation of that consumption pattern, that the consumer does feel the tariffs, and they're consuming less stuff that are tariffed and more stuff that isn't, i.e. services. But the bigger question I think that a lot of people are asking away from tariffs is what the fiscal implication could be next year, and whether or not fiscal stimulus will move the needle. Our baseline is that on the margin, it's supportive to the U.S. economy, but we still have a lot of pluses and minuses to think about for what fiscal stimulus could mean in Q1. With the tax, so the tax cuts that are coming are for overtime work and for people that are waiters, that they get their tips taxed. That's not really going to move the needle that much. The thing that's really going to be stimulative in Q1 is the tax breaks that corporates receive. Although on the margin, the consumer should be in a slightly better place, though not anything like we saw in the 2017 tax cuts. So overall, the consumer's in a decent place, but there's a lot of bifurcation in terms of what consumers are consuming and which consumers are consuming. So we do have a lot of published research on that, which we can follow up on later. In terms of housing, we saw some upside surprise in the housing data yesterday, but overall, the big picture is that the housing is likely to continue to stagnate. Jay Bacow and Jim Egan, who are kind of U.S. gurus on housing, have indicated that we still need many more basis points, like over 100 basis points of compression in mortgage rates, to really get supply and demand to clear at a clearing level. And clearly the administration is working to try and find solutions to get in that direction, but we're still not there yet. So right now we're expecting, very modest housing activity in the U.S.
Thanks very much, Rajiv, and thanks for your time today. And then next we'll move to the questions on China, and then the first several questions are for Laura. The client is asking whether we should expect the Hong Kong market to catch up to A-share in the near term, and then what catalysts should people be watching for the Hong Kong equity market. And then the second one is the earning revision breadth seems to have dropped down to slightly above 0, and then what have dropped down the earning revision in terms of the sector composition. And then the last one is I know that there is a lot of interest during your US marketing, but then have the real money come into China, and then if not, what are the key bottleneck that are stopping investors, and if yes, what people are buying?
Thanks very much, Crystal, and thanks to the investors who raised these very good and valuable questions. So the first one, how do we think about Hong Kong versus the Asia market? With the margin financing tightening measure that came out yesterday, I think that the Asia market could potentially take a temporary breath and take a little bit of break. If you look at how the onshore market has been doing today versus Hong Kong, it's actually slightly dropping more than the Hong Kong market. So that could potentially give Hong Kong a chance to catch up. That being said, as I mentioned earlier, I think the liquidity support for the onshore, I would say from a scale perspective, it seems to be bigger versus what we can see for Hong Kong at the moment. And also, let's not forget how last year Hong Kong actually had outperformed the Asia market. So what we're seeing at the moment is really just a catch-up game that a share market is playing against the Hong Kong. If we look at this whole rally that started last year, but not if we do not only look at from the beginning of this year. I think on a 6 to 12 months basis, we actually think both markets would perform relatively on par. With Asia market offering unique opportunity sets, as I mentioned earlier, and the strong liquidity support. Whereas for Hong Kong, I think given the relatively underweight positioning by global investors on Chinese equities, Hong Kong and the ADR space would still remain the first stop for global investors to build up their China exposure. So I think, and also the Hong Kong offers also a lot of large cap, highly liquid names with AI exposure and with new consumption exposure, etc. And particularly if you are a long-only or mutual fund long-term investors, you also want to think about some of the good high-quality dividend plays that Hong Kong actually offers very good value for these stocks that are both listed in Hong Kong and Asia, and with the H-share being valued at a more attractive price. So I think on a 6 to 12 months basis, we reiterate we expect both markets to perform relatively on par. Earnings revisions, yes. So China's earnings revision turned positive for the first time in 3.5 years back in August last year, but that momentum has slowed down. It's still above zero. It's still positive, which means we are having more positive upward earnings revisions than downward revisions. But yes, the momentum has slowed down. This is mostly triggered, in our opinion, by some of these large internet e-commerce players who have been engaged deeply in price wars since mid last year, and that had caused severe earnings expectation reduction, particularly in the consumer discretionary / internet e-commerce sector. And with the government shifting their focus back on anti-involution, we already are seeing a number of announcements and documents being released over the course of the last week. So hopefully the demand dynamics can be rebalanced faster, particularly in this space, and that will help improve the margins and earnings, etc. And hopefully that could help stop the current slowing down momentum of the earnings revision breadth and potentially reverse that back up to a re-accelerating mode. The last question, real money coming in from investors. Yes, it is already happening. For 2025, our data shows that there has been a net $14 billion worth of foreign inflows coming into Chinese equities. That's mainly driven by passive inflow, but I wouldn't take this as a passive result of index rebalancing due to China's outperformance. In fact, if you look at the rebalancing magnitude, the magnitude of Chinese equities going up versus the rest of the index, and then how much flow has coming in, we are seeing actually additional passive inflow coming into Chinese equities as an expression of overall macro views and index level views instead of doing stock picking. We are seeing more and more that kind of actions taken by quant funds, by macro funds, and by index funds, and a lot of asset allocators are using these tools, these vehicles to actually express their more positive views on Chinese equities. Compared to 2024, we had a net outflow of $17 billion. So 25 is already the turning point of foreign investors coming back into China, and we expect that to continue in 2026. Thank you.
Thank you very much, Laura. And then we have two more questions for Jenny. And then the first one is in terms of the CNY appreciation. If China really wants to internationalize the currency, don't they want to gradually let the currency strengthen? And then how does a currency, stronger currency impact export? And then also how does it impact the domestic economy?
Okay, thank you, Crystal, and thank you for this interesting question. So when we talk about PBOC's attitude toward renminbi, that it doesn't want renminbi to appreciate by too much, we are actually talking about the renminbi CFA basket. And the reason is that the PBOC actually also see the lessons from Japan in 1990s, and it's not a right choice to push for currency appreciation when the economy is in deflation, because first, it can hurt the exports, and second, it will tighten the financial conditions. But when the economy is doing the deleveraging, the tight financial condition is the last thing it wants. And the third is that a stronger currency will lead to lower import prices, and that will actually just amplify the low price expectation. So that is not a good choice. But in the meanwhile, you can see that the PBOC are actually not using the CFA basket, but it's using the USD CNY to anchor the market expectation. And over the past years, when the renminbi has the depreciation pressures, you can see PBOC always safeguard the threshold of 7.3. But when the dollar weakened, and the PBOC will just let renminbi appreciate. So this way, it can keep the CFA basket relatively stable. And in the meanwhile, the USD CNY appreciate. So that will give market more confidence on the CNY. Yeah. Thank you.
Thanks very much, Jenny. And in the interest of time, we'll conclude today's session here and answer the remaining questions offline. Thank you so much again for joining us, and do reach out to me and the team if you have any other questions. Have a nice day, and I will see you next week.